Hello. Welcome, guys. It's Jeb Smith and Josh Lewis. We are your Live at 5 team here, answering real estate and mortgage-related questions, helping guide you through that process, hopefully making sense of a crazy real estate market, and, getting you towards home ownership. So if you have questions, put them in the description below. Happy to address stuff. Try not to do it more than once. We'll do our best to get through it. Josh, welcome to the show, my friend. It's Wednesday.
Thanks for having us. Yeah. It's hump day. Happy hump day. Can we get the little camel to cruise through the bottom of the frame?
If we were a higher production show, probably it's not in the budget at the moment.
All right.
10 sleeps until Christmas. That's the kids. If you got kids, they're probably excited, ready to go out of school next week. So I don't know. Are we going to be here next week, Josh? Wednesday before Christmas?
Well, here's the deal. I'm down, but I'm going to be in the truck heading to back to Washington. So let's do it. Let's do live from the vehicle. Live rolling at 5.
We can see what we'll put together. So hopefully we'll be here next week, guys. So what's happened in the real estate market in the last week? Inventory continues to shrink in a lot of markets due to the time of year, right? It's that seasonality, the fall winter market for many of us out there. If you're in an area that gets snow, those markets are going to probably suffer more than most. Here in Southern California, we have 93 active homes in Huntington Beach on the market, 1249. Is that what I said in all of Orange County? Josh, I ran a stat after you left. Single family homes under $1 million. So detached single family homes in Orange County, 3.3 million people, 178. So there's literally nothing out there, people. Not a lot to choose from. But since then, earlier today, the Fed came out, right? Starting to change their stance a little bit on the inflation numbers, starting to tighten, they're tapering a little bit. So based on what the current tapering, it looks like they'll be done by March. And essentially what they've stated at this point is that they want to get the tapering finished before they start considering raising that Fed funds rate. So they start in March or finish in March. That means they could start to raise short-term rates as early as April, maybe. And they said 3 rate hikes are what they're shooting for. I know we have some thoughts on that. So Josh, thoughts? Let's talk about it.
So first off, what we want to look back to is every time the Fed gets ready to take away quantitative easing or increase rates, it's the flip side of, I don't know if you guys remember, right when COVID got super serious, on a Sunday, the Fed calls an emergency meeting, takes rates to zero, and I got 9,000 calls on Monday. I want one of those 0% interest rates. So
I
it's
do
not,
too.
I do too. Not exactly how it works, but it did. It impacted rates and moved them much lower. So when the Fed acts really aggressively and moves rates lower, it will move rates lower. But the flip side, going the other way, paradoxically, does not increase interest rates. What increases interest rates and what freaks the markets out is inflation. So right now we're going on 3-4 months of really hot inflation numbers. So we had a few months in the spring where like, whoo, that's not surprising, but hot. And the numbers have been even hotter here recently. The bond market and mortgage bonds and mortgage rates not really up. They're up, but nothing drastic. So they're looking further out into the future. When you say a mortgage bond, a mortgage could theoretically run for 30 years. It's a long-term commitment. So how worried are we in the short run about inflation? Not worried at all. Basically, when you look at the market and looking back historically on the 3 rounds, 4 rounds of quantitative easing we've had since 2012, 2013. We did have the taper tantrum in 2014 where they started to taper their bond buying. They didn't give any advance notice and the bond market freaked out and then went right back to where it was. Long way of saying, we talk about this every week on the show. There's a long-term down channel in bond yields and interest rates going back to 1982. Nothing has happened to change that. All of the things that are going on, nothing has told me that anything is different. Now, what we always want to be aware of, we also talk about that's a downtrend channel. Within that channel, for periods of time, rates can go up, rates can go down. So when we look at that, we are trending up slightly. From most everyone in the mid to high 2s to most people in the very high 2s to low 3s right now. Any way you cut it, rates are amazing. But long way of saying, the Fed doing this is helpful. The markets, when we saw rates start to trend up a few months back, it was because they're looking, going, hey, Fed, how about you guys step in here and do something to slow the economy down instead of continuing to stimulate it while inflation is getting a toehold. So you saw the market didn't really react. I don't know, Jeb, if you saw we were down 17 basis points on mortgage bonds. I need to look. I don't even remember what the 10-year did. 10 years up 3 basis points. That's a giant yawn from the bond markets. They're like, cool. Stocks liked it. Stocks actually stepped in and went up, which is a little bit strange. Usually they love the really ultra low rates. Their cost of borrowing is more directly impacted by Fed movements. So long way of saying, I think the news today was good. I think their hike is good. So them getting out of bond buying in 3 months, perfectly fine. Getting into raising rates, short-term rates that they control earlier in the year, good. I think by this time next year, we're going to look back and realize that the inflation stuff was overblown. You and I talked here earlier. The National Federation of Independent Businesses came out with their report yesterday on small business confidence, and the confidence levels are down. Right. We're looking at retail sales figures for the holiday season, slower than expected. So these are not big numbers that are just market moving off the charts. There's reasons that we talk about here every week. We have supply chain issues. We've talked about those ad nauseum. We have increased demand because of all the stimulus. The last checks for the additional child support from the government have already gone out. So basically all the money that's going to be given away by the government due to the pandemic and support is gone. So the additional spending cash in the economy is there and not going to increase. Supply chain issues will work themselves out over time. We still have demographic issues with an aging population. Boomers leaving the workforce decreases productivity for the entire workforce and GDP going forward, and that's deflationary. So there's nothing that tells me that this blip that we've had for the last year is a change in the long-term trend.
No, agreed. It's headlines, right? I mean, there's going to be a lot that come off the headlines that we talk about this all the time. Again, you said ad nauseum about, some of the things that we talk about. And that's another one, right? The headlines are going to read a certain way. You just got to know what you're reading in order to get, accurate information. At the end of the day, nothing matters. I don't care what happens in the economy. I don't care what happens in the world. until you get an increase in the supply of homes, the market doesn't change, period. End of story. Nothing changes. Now, all of those things can eventually affect the supply, can eventually affect the demand, which creates more supply. And it may, right? I mean, we know for a fact there will be more homes on the market in the spring than right now. We know that. I mean, it happens every single year, seasonality for sure. And I can tell you, as I've said in multiple videos, I have people that I've talked to that are ready to list their homes come the spring. Now, these are people that are already thinking about listing their homes. They're just waiting because, they have kids, Christmas, holidays, families, whatever. They don't want to deal with doing that right now. Some have new construction properties that they're planning on moving to in the spring. And so there's a lot of reasons that people move, but at the end of the day, you're going to have more supply. And so the real question is what happens to rates? Well, probably not a lot in the next couple of months, right? I mean, I think we can all agree that if rates move, it's going to be pretty minimal with regards to whichever direction they go in, say, the next quarter, right? Not a lot's going to happen until the tapering fully ends and they do start to raise short-term interest rates or the Fed funds rate or what have you. So agree with that, Josh? Is that a fair statement?
Yeah. Yeah, I don't think that there's any big change coming, but the big thing, and you already hinted at it and can go in greater detail on it, it's tiresome to see headlines about the slowing real estate market when we're really talking seasonal changes and slowing in terms of sales volume due to lack of homes available to buy. If the market goes from X number of sales in a month to 100,000 less sales the following month, but there were 200,000 less homes on the market, it doesn't mean that there's buyers less, that there's less demand out there for buyers to get into the market. And we're seeing more demand than supply. Until that changes, home prices continue to go up.
Probably and the last thing I'll say before we start getting into some questions is, listen, the next existing home sales report that comes out, the next pending home sales report that comes out for the month of December, it's going to go down. There are less homes to choose from, less opportunities to go into escrow. Simple, right? We had this conversation a couple of months back when inventory really tightened up in the spring. We said the same thing. As more inventory started to come up, we saw those numbers pick back up again. It's going to be a similar story. Just understand the market that you're in. Real estate's local, right? If you're in Southern California, you have very few options to choose a home. There's just not a lot out there. In some markets, there might be more property. And in those markets, the market might be a little bit different. So just keep that in mind going through it. Joseph is asking, what do you think about a cash out refi and shorting the market? So clearly we're not an options channel, a stock channel, anything like that. But what I can tell you is when you short the market, you better have time on your side. And don't do it on margin, because you can really get your ass kicked in many ways, and especially if you're doing options, naked options, that sort of thing, naked puts, calls, whatever. You better know your game, my friend, and be ready. Be ready. And there's still a lot of money out there in not just real estate, but in the market in general. Look at how much equities have gone up. And while people say it's a bubble, people say whatever, the reality is prices have gone up. Therefore, there is more cash in the system. With Fed funds rates staying low, the cost of borrowing money is very cheap too. And so that's going to be the case for some time. Now, again, the stock market also has seasonality. It has ebbs and flows just like the housing market does. Now, not exactly the same way, but this time of year, stocks tend to go up a little bit. After the first year, towards the end of the year, people start to pull money out, pay taxes on it. Maybe they have to sell some to actually pay other taxes. So you're going to see some movement in the market either way, but shorting it, I'm not sure that's the right call. Josh?
No, there's a simple one that I love to always fall back on in this case. Markets can remain irrational longer than you can remain solvent. So we can all sit here and agree that by textbook definitions, the market is overvalued, but it can remain overvalued longer than you can remain solvent in your short position. So I don't disagree with the thinking of what you're saying. I don't have the huevos to throw margin money down on the block to say when exactly this is going to happen.
I'm with you, my friend. And Jennifer Lego's in the chat. So Jennifer, thank you for being here. She's going to help us moderate. So be nice to Jennifer. And if you do a lot of emojis, you do a lot of caps, unfortunately, Nightbot doesn't like that. And you might get reprimanded from Nightbot. We're going to say he's a she. He's a she. Nightbot's a she. Because
she can get away with being more aggressive.
Yes, exactly. So we're going to go that direction. So Johnny is saying after 9 months and 30 offers, finally got an offer accepted, went $150,000 over the asking price and Zestimate. Did I overpay? Hard to say, right? Hard to say without actually knowing the property. What I would tell you is give zero value to a Zestimate, like zero for the most part, right? I don't look at Zestimates. I'm a real estate agent. Clearly, when I go to price a home, I never look to see, hey, what does Zillow think it's worth in order to get my opinion of the value. We've talked about this before. Zillow, unfortunately, their algorithms, while their AI and all of that stuff is really good in some areas, their estimates, there's a lack of real information that goes into creating those numbers, because here's how they come up with them. And I don't know this to be precise, but what I have to think how algorithms work in the real estate space is that, it's looking at a property that you might be interested in. Let's just say it's a 3-bedroom, 2-bath, 1,400 square foot home. Well, what it's going to do is go out and try to find 3-bedroom, 2-bath, 1,400 square foot homes somewhere in that area. It doesn't know if that house backs to a street, doesn't know if that house backs to a freeway, doesn't know if the interior of that house has been completely remodeled, doesn't know if the interior of that house is completely original on what it's comparing it to, right? All it is doing is taking numbers, a statistical approach, multiple sets of numbers, and trying to come up with an idea of value based on that. I've listed several properties in my career where the Zestimate was way below what I thought the property was worth. And once I listed the property at X amount, the Zestimate seemed to get, a little bit of steam momentum on its side, and it ended up changing its number to reflect my number. And nothing changed other than me adding that property to the market. Same thing with a property that's priced a little bit high on a Zestimate. You go in and price a property for what you think it's worth in that market, they seem to change their value. So it's that number can be manipulated very, very easily. So it's as simple as that. But I would say that you're still in a market, depending on where you are. I don't know where you're located, but if you're anywhere near us, I mean, I don't think you're overpaying for a house at the moment. I think property values are going to continue to rise. Now, I don't know if you paid way over based on comps or any of that, just based on the information. But I do think, again, I think the spring is going to bring more inventory, but I think it's going to bring more buyer demand. And I think you're going to see home values increase. That's just my opinion, right? A lot of people, you can call me a clown, you can call me whatever, but it's
too mild. I'd go more aggressive with what I'd call you.
Yeah, go for it, bro. Let's put it out there. No, but I wouldn't be afraid. Listen, my wife looks at the market every single day looking for a property. In fact, she probably looks at property more than I do. And
the problem is she takes Jeb's max budget and puts 500,000 on top of that and then goes shopping.
Yeah. So, here's the deal. If the right property came up tomorrow, I would not be afraid of putting in an offer. How's that? That's obviously we would have to figure out the right price, but I wouldn't be afraid to buy in this market. That's what I would say.
Jeb, let me throw this out there, because this is actually insightful. Saying, hey, did I overpay based off of what the Zestimate is? I have a client who is in a very bad reverse mortgage. You and I hinted at this last week, that you can get screwed on a reverse mortgage worse than just about any product out there. The person who did her $550,000 loan made somewhere between $80,000 and $100,000 on that loan. And yes, you heard that correct. And yes, that is inappropriate for anyone doing anything related to a mortgage to your home to make $80,000 to $100,000. But long way of saying, we're trying to refinance it to get her to a much lower rate, because even on your reverse mortgage where you're not making a monthly payment, what would normally be the monthly payment gets added on to your loan amount. So her equity is getting eaten up much faster than it needs to, because the clown that sold her a loan wanted to make $100,000 on her loan. Long way of saying, we need a really nice appraisal, a high value for her. So we're doing some research. So first hit, the easy one is Zillow and Redfin. Zillow thinks her home is worth $900,000. Redfin thinks it's worth $1.1 million. It's a pretty big difference. In this instance, you're saying, hey, did I overpay? I went 150 over what the estimate is. In her case, I know for a fact that the 1.1 is even conservative. So if she paid 150, if someone bought that house, paid 150 over that 900,000, you're at $1,050,000. You got a deal on it. I looked at a better proprietary database that actually uses MLS data directly, and they thought it was $1,150,000, and somewhere between $1,100,000 and $1,200,000 is the value of that home. So like Jeb was saying, sometimes it's very accurate, sometimes it's horrifically inaccurate. My home is always $100,000 to $250,000 low because we're surrounded by different homes of different ages, sizes. Never gets the price right. So if you're in Southern California, generally pretty accurate. If you're out in more rural areas, I've got family in Washington, and it's just not tract homes like we have here in Southern California. The more different type of inventory you have in a given area, lot sizes, composition, who built the home, was it custom, was it tract home, the more incorrect and inaccurate it can be. And Jeb, I don't know if you want to digress for a minute. We don't have a ton of questions here, but we go into the appraisal issue a lot here. I'm doing a refinance on the property in Orange. We're doing a refinance on my home. We had appraisals on both of them this week, and very interesting conversations and experiences with both appraisers. I think both of them were good. I think they're both going to come in with low values relative to what I know the homes would sell for. And oftentimes, Jeb, I'm sure you don't get involved with the refi. So if there's a low appraisal, if a buyer feels the appraisal is low, they're gonna scream because it's gonna cause us a problem. Well, we get this on refis all the time. Doesn't even make a difference. The home appraised for enough to do the loan and have the terms that we quoted. That's way low. Mine came in low. So just kind of want to talk about why that is. For my home, we told the guy I only needed $1,250,000. Anything above that would keep the terms the same. He brings in $1,275,000, which is anywhere, what, Jeb, 100 to 200,000 low on my home.
Yeah.
So when we're looking at that, we go through it, and I told him, I go, the homes behind me, you can't use. The homes across Springdale, you can't use. The homes across the way are even a little bit higher, even though same vintage, same size. They have a different school district. They get even a little bit higher premium. We go through it, and what does he do? He goes across the major street, uses those two comps, and brings it in low. It didn't matter, and he probably did it because it was easy. But the flip side, the property we have out in Orange, it's an infill property. So everything in the area is 6,000 square foot lots. This is a 3,000 square foot lot, and it has an HOA, even though it's a single family residence. That really limits the appraiser on what they can do and what they can use. So long way of saying, we talk to people all the time, and they freak out and they go, this appraiser's an idiot. This appraiser's incompetent. What are they doing? Do they hate me? They were rude to me when they came out. I had a lady, African-American lady last year, she concluded that it was a racist appraisal. I go, trust me, their stupidity is colorblind. But the reality is they have guidelines that they have to follow. And a lot of times these are difficult appraisals. My house is difficult to appraise. I know that. The house that we have in Orange, difficult to appraise. We know that. They're both going to come in low. But just kind of wanted to give you guys some insight. So zestimate's not right. Even the appraised value, it's just a person's opinion based off of appraisal guidelines. These are not facts. The only facts are, what will a seller accept and what are you willing to pay? Those are the facts.
Yeah, and last thing we'll say about this, and we'll shut it down. Zestimate is just a tool in your toolbox. It's one of the tools. It's not your only tool. If it's your only tool, you're not going to be successful as a handyman, a contractor, whatever. But if you've got multiple tools that you can use and combine all of them to get the job done, so to speak, you'll be in a much better position. Same thing with a Zestimate, right? It is a one of the pieces of the puzzle for some people to get there, right? It's not something I use, but in some cases, it is a little bit more, it can be accurate, but it's on certain properties, condos, townhomes, where there's tract development. A lot of properties have sold, that sort of thing. All right. So Kevin saying, do you guys expect demand to increase even more with rising interest rates on the horizon? If so, what do you think may happen? So here's the thing. I mentioned we kind of spoke on this a moment ago. I do expect demand to stay where it is for the time being, right? There's a lot of people out there at the moment that haven't had the opportunity to buy a home, right? They've either been outbid, they're either just starting the process and getting, in the game, so to speak. They haven't found the right home because there's been a lack of available inventory. As the inventory picks up in the spring, demand is going to either pick back up, however you want to say it, or it's going to increase. However you want to look at it, the result's the same. Properties are going to come on the market. They're going to be met with buyer demand. Now, as you start to see, if you see a huge increase month over month over month in supply and demand's not there, you're going to have supply build, and eventually that'll slow the market. I don't think that's going to happen. I mean, a lot of the economists out there are actually predicting this year we're going to end the year somewhere around 6 million sales in the United States. So 6 million homes are going to sell in the United States, give or take a couple 100,000, in the United States. Many economists out there are predicting that number to be less in 2022. And part of that reason is because they feel that interest rates are going to go up, which is going to price some buyers out. Affordability is going to be a problem for some people. But when they talk about a decrease in the number of sales, it's like a 2%, right? Decrease. And give or take these numbers, these guys are pretty good at predicting these numbers. I mean, they're usually pretty close, within a percent or two of what they think. But they think next year is going to be 2% less in the number of sales. So, take that for what it's worth. It doesn't mean, there's going to be a significant change in the market, but it is going to change a little bit if rates do go up, because there are people on the threshold of just being able to qualify for some properties, right? Those people might get priced out of those markets if rates rise, right? In the other, but that's, as I mentioned in the video that I put out, I think this week, did I do a video or last week? This week, I think this week. It's going to affect more first-time home buyers. That's going to affect the lower price points more than anything else. It really is, because if you're a move-up buyer, chances are you're selling a property, you're taking equity from that property and moving up. If you're a luxury buyer, you're kind of in a different world to begin with. If you're an investor, a lot of times you have cash, so you're less affected. The people that are affected are the people putting less down payments, just coming into the market. Those are the people that are going to, get affected the most. So, I think you're going to see demand increase. I think you're going to see supply increase. I think you're going to see rates increase, but I don't think rates are going to go crazy. I think you're going to probably see them somewhere in the mid threes for probably the good portion of the year, if I had to guess. And so I don't know what that does to the market. The question is, how many people are truly on the edge of affordability? That I can't answer. Josh, what are your thoughts on?
So most of the experts, and be careful with
With
that,
the
but
word expert?
let's say experts that I trust think that nothing happens to demand until you hit 3.75 to 4%. I'm going to pull up a fun little chart here so we can get a look at it. I don't believe that's happening anytime soon. So just to give you guys a view on this little channel, this is the bottom of the channel, this is the top of the channel, and these are not perfectly drawn here in this system, but this tells you that's a downtrend in bond prices. That means an uptrend in interest rates. You go, yep, that's what I keep seeing. I keep seeing in the headlines, rates are going higher, rates are going higher. Well, from here, our absolute best day, well, we were here and here. So this was back in October. This was in November. Now we're into December. From our best to our worst day, that's about 1/4% difference in interest rate. So that's just the last quarter. Let's go out over 6 months. And you go, okay, well, if we go further, that's another 1/4%. I mean, take out these couple of days here that were our absolute best. This is about 0.5% range. Long way of saying rates haven't moved a lot. They've already popped up. If we were to believe that inflation is such a massive problem, they would have spiked a bunch more than this. The Fed stepping in, we can kill two birds with one stone. Let's throw another question here. Johnny Coe, another Johnny, pops in, says, sorry, late to the party. Will today's Fed announcement of a faster tapering affect rates by summer of 2022? It should, and it should keep a lid on interest rates, because again, it shows that the Fed is serious about fighting inflation, not letting it get a toehold. All of the other long-term factors, massively excessive government debt, a graying population, all of those things that lead to lower productivity, lower growth, lower inflation. We don't want to call it deflation because it's not deflation, it's disinflation. So I am zero worried about inflation in the bigger context. So could we hit to that 3.5, 3.75 level? It's possible. I don't think it's going to happen. I think what the Fed did today is a good thing. If they jump in and they start hiking rates, it's a good thing. I think we're going to look back and say, it was negative in that it will get us to recession sooner than we otherwise would have, but I don't know that the Fed has any choice. They really don't have any good decisions or good choices to make right now, and this is the best of all of the choices, that they have in front of them. So it's the right thing. It's a good thing. It will keep a lid on interest rates. So in terms of affecting demand, no. The big thing that's going to affect demand, we talk about this all the time, people probably get tired of hearing it, but you can't fight it. It's demographics. The wave of millennials entering prime home buying age exceeds the boomers dying out and selling off their homes. So we have an increase in aggregate demand. We don't have an increase in supply because people are staying in their homes longer than ever. So supply demand imbalance, low interest rates supports purchases. It is what it is. Home prices are going to continue going up for the foreseeable future. The question is that a 3% annual increase? Is it a 12% annual increase? Probably somewhere in between there, but that's the numbers that we're looking at.
Yeah, Josh, I sent you an article the other day. We never talked about it, but this guy goes on to say that he believes that we're in the first year of a 10-year bull cycle in housing. I'm like, that's aggressive,
That's very aggressive.
But then if you read the statements that all of it makes sense to me. It all makes sense. It's just, I mean, that's a big statement to make. So, anyway.
Jeb, here, the thing that jumped out at me, and there was a number of points I wish I had read it more closely. I read it while I was driving in the car with my wife. I wasn't driving. I was passengering in the car with my wife and read through it. And I'm like, that's a good point. That's a good point. That's a good point. One of the things the gentleman pointed out was in 2007, we reached an all-time high of household incomes going to debt service on mortgages, and it reached 7%. Right now we're at 4%. So, I mean, that tells you people look, oh, home prices are higher than they were last time we crashed. Well, cool story. It doesn't matter. Interest rates are lower, incomes are higher. We literally have about 60% of the amount of household income going to mortgage debt service that we had at that time. We have record levels of net equity in homes. We have low interest rates. We have higher average credit scores in those borrowers. Going back to when Jeb and I started doing this, middle of last year, everyone wanted to say, so when the forbearance end, when are all my foreclosures coming? There's no foreclosures coming, none. We currently have a record low level of foreclosures, which is artificially low because of forbearance. Some people who would have fallen through the cracks and lost their home to foreclosure didn't, but the numbers are so minuscule that they're just not there. We have the strongest cohort of homeowners underwriting wise that we've ever had. So there's not going to be a big downturn. We could see it flatten. We could see it flatten for an extended period of time. But if you're hoping that there's going to be some big dip that you're going to jump in at a better point in the future, what do we say about shorting the stock market? Markets can remain irrational longer than you can remain solvent. This market's going to remain irrational for an extended period of time.
Nope. I'm with you. So I'm going to do something a little bit different here. I'm going to tell you, normally we don't do this early in the show, but we always get people reaching out, asking about, contact information, all of that. I'm going to put it here on the screen. Josh's contact information, myself. If you need, an agent anywhere in the country, network with, experts all across the country, have a network of experts that I'm happy to put you in touch with. I'll put a link up here on the screen in a moment. Connect you to one of those. Same thing with mortgage. If you need a mortgage professional, reach out, click that link. Again, get you connected with somebody. And if you haven't done so already, hit the little thumbs up. That stuff helps. So what we're going to do here is we're going to get to our next question. So I'm going to put that on the bottom of the screen for a moment. And then we're going to go to Grace's question here about appraisal. So what's the main difference between purchasing a new construction home versus an existing home when it comes to appraisal? In my experience, I've never seen a new construction appraisal not appraise. Simple. They have way too much data to back to get those appraisers to appraise those properties based on other sales in the community. it will always appraise, always, relative, right? But I would say you're very high percentage chance that it'll appraise with new construction versus existing construction. They're not using new construction homes. They're using homes in different tracks and different areas to try to get that value. And those can fall short sometimes. Other than that, the process is more or less the same.
And at the end of the day, as a buyer of new construction, it's pretty transparent to you and you really don't care. I would say with 99% plus certainty, it's going to appraise for what you agreed to pay for it. That document comes in, you're going to look at it, you're going to read it, you're not going to understand anything other than the part that says, hey, it appraised for what you agreed to pay for it, and your loan's going to close. So really doesn't matter.
Nope, it does not. A landlubber says the cash out refi to short stocks is the dumbest thing possibly he's heard all week, or she. There's still time, man. It's only hump day, bro. You still got
Dude,
4
well,
days
hey,
to hear
hold
something
on.
dumber.
I
Hold on, we got
told you, Jeb, that I had a client reach out this week, and this wasn't dumb. I don't think asking the question about shorting stocks was a dumb one. It's super risky. I don't think anyone should do it, but asking the question, the fundamentals behind the question make sense. Like we said before, I had a client reach out this week, said, hey, tell me why I shouldn't take cash out of my house and buy a bunch of crypto.
We talked about it last week.
I said, and my thought was, okay, this person's never bought crypto. They want to take, 50,000, 100,000 out of their house, and they're going to buy crypto. So talk to the guy. His home's worth about $1.4 million, $1.5 million. He owes $650,000 on it. He wants to take out about $250,000 and literally buy crypto. I said, okay, how long you been in crypto? A couple of years. Okay, what are you in? And he names all the different cryptos that he owns. And what's your strategy? He tells me his whole strategy. Is okay, what other assets do you guys have? I got about $1.5 million in my 401k. My wife has about $2 million in her 401k, and they're about 10, 15 years away from retirement. So I said, cool. You want to do this? You know what you're doing. It's not like he's walking into it blind. He knows what crypto is. He knows what the investing looks like. He has if he lost every dime, he's still going to be fine. Right. And in that perspective, so everyone's different. If you just bought your first home and it went up $100,000 and you say, hey, Josh, how do I get 100 grand out? I want to go buy Bitcoin. I'm gonna say, well, do you own any? It's not as simple. So just be cognizant of everyone's situation being different, everyone's risk tolerance being different, and what's appropriate for one person may not be appropriate for everyone.
Good stuff. Chels says, we are listing our home this week in Utah. How long do we have before we need to pay capital gains tax? So you'll pay any capital gains in the year that you sell the property, right? So if you sell it at this point, it's not going to sell this year in theory, right? I mean, if you list it this week, it's going to sell in 2022. So you would pay those as part of your 2022 taxes. Now, capital gains, for those of you who don't know, when you sell a property, and it's your primary residence, or let's just say this, when you sell a property, there are taxes associated with the gain on that property. So if you sold a property, if you bought a property for $500,000, you sell it for $700,000, in theory, you've got $200,000 in gain, minus some fees or whatever associated with it. But there is an exemption. If it's your primary home, if you've lived in it as your primary residence 2 of the last 5 years, and you haven't done a capital gains exemption within the last 2 years, you get up to $250,000 tax-free as a single individual, or $500,000 married, that's exempt from any capital gains tax. So in the example that I used a moment ago, you bought it for $500,000, you sold it for $700,000. There's a $200,000 gain there. You pay no taxes, even as a single person, no taxes on that $200,000. Now, if it were $700,000 and you were married, you've got potentially $200,000 there, again, minus fees, improvements, and some other things in there that you have to pay capital gains tax on. So just something to keep in mind when people sell property. You gotta keep that in mind. And for example, I have some family at the moment that's potentially looking to sell a home that they bought about a year ago. It's gone up in that time frame. And if they sell before that 2-year period gets here, they're going to have to pay capital gains on part of that money because they haven't been in there 2 of the 5 years that's required for that exemption. So talk to an accountant, talk to, a tax pro. They can help you with it, but you pay it in the year that you file your taxes. So it would be due by April of the following 2023 in that case. assuming no dates change. But that's where it's at. Let's see. Savannah says, are appraisers keeping up with the market? Our last home fell through because the appraiser from being appraised too low, but the comps around where were all being sold for way over our house. Appraising at the moment, Josh hinted at earlier, is a tough deal at the moment, especially if you're in a market that could be a little bit more rural, not a lot of comps to choose from. Even then, it's a hard gig, just because the market's moving faster than these guys can really have data to support in some ways, and that part's difficult. You don't know. At the end of the day, a home's worth what somebody is willing to pay for it, but an appraiser has to justify that on paper so that the bank agrees with it, right? They can't just say, well, there's 5 offers at, $100,000 more than the asking price, therefore that's the value. That's what it should be to some extent, but that could all be falsely made up, right? So they need some true data that's closed, that's recorded, to be able to back up those numbers. And sometimes when the market moves that quickly, like we've seen over the last year, you don't have the numbers there, right? It takes, you list a home on the market, and by the time it shows in the MLS as a closed escrow, that's over 30 days from when that property originally went under contract. So, and that's what a lot of people don't look at, is that, okay, it was listed at X amount, it closed 30 days later for X amount. Now you're listing your home at a later date. You've got to factor in what the market's doing with regards to appreciation. And sometimes appraisers have a hard time with that and hard time justifying it. Even if they believe it, putting it in paper, putting it on paper, you can't give a true number to some of this stuff because of it's hard to justify. Josh, thoughts on?
Yeah, the thing I would say, so okay, homes around where you're buying or sold for way over your house. You can't just go off of that. An example would be my house. My house is the smallest home in my neighborhood. They range from my little guy at 1750 up to the big ones, 2700. One at the end of my street just sold a week ago, 2 weeks ago. It was the big guy, 2600, and it happened to be at the end of a cul-de-sac, 10,500 square foot lot, which for us is huge. It's 4,000 square feet bigger than my lot. That thing sold for $1.8 million. We had one of our neighbors jump up and down going, I'm putting a sign in my yard. If our homes are worth 1.8 million, I'm selling. I said, your home's not worth $1.8 million. Their house is 500 square feet bigger than yours, and they've got 4,000 square feet of land that you don't have. There's no comparison between those two. And my neighbor who was saying that I know what the subtext was, their house is much nicer than the house that just sold. But it doesn't change the fact that it doesn't have the extra 450 square feet or the 4,500 square feet of lot. What people don't understand is adjustments of what appraisers need to do to adjust for location, lot size, bed and bath count, amenities like pools, AC, all of that stuff. Appraisers are not dumb. There's no world in which you as a homeowner or home buyer are seeing data that they don't have. So you don't know the guidelines that they have to operate under. Now, having said that, I say they're not dumb. Here's something that's pretty dumb. My house, single story house with a 3-car garage, very rare in our area. People pay a massive premium for it. Jeb, what would you guess my extra 3rd car garage would be worth over a home without it in my neighborhood?
Am I guessing what the appraiser put it was worth, or am I guessing what it's actually worth?
It. You come to list my house. How much is that 3rd bay in the garage worth?
Well, I don't know. That's really hard to justify, man. I've never even really considered that.
Give me a wild ass guess.
50 grand.
50 is a safe low figure. The appraiser gave us $15,000. There's no world in which that's a $15,000 amenity. As soon as you put a house in our neighborhood up, single story, 3-car garage, there's an element. Agents like Jeb have a list of people that are like, hey, let me know when a single story with a 3-car garage comes up. So
yeah, because I'm buying it.
It doesn't mean that it's logical, of the adjustments that they're doing. And the one at the other end of my street, it doesn't have the 10,000 square foot lot and it backs to a busy street. They used that in my appraisal. I look at the adjustment. It was like a $10,000 adjustment to the busy street. Jeb looked at a house 4 years ago on that street and he goes, I wouldn't buy it because it backs to that busy ass street. So you look at these things.
now it's worth 1.4.
I think they sold it for 810 at the time. You probably should have
I
bought it.
think I negotiated 810 on it.
Uh,
That's great.
So,
Anyway.
long way of saying the adjustments don't necessarily make sense. They're not logical. The appraisers are supposed to use a paired sales analysis, meaning they need to go find another single story with a 3-car garage and then a single story with a 2-car garage and go, here's what the difference is. In reality, they don't do that. They go to these rules of thumb. I asked the appraiser today on the property in Orange. Ours has a 3,000 square foot lot. The other comp that sold in the development had a 2,000 square foot lot. I said, how much is my 1,000 square feet of extra lot going to get me? And I'm thinking she's going to come back 25, 35,000. She goes, it's about $5 to $10 per square foot. So you're going to say $5,000 to $10,000 for me having a yard and them having a patio that's 4 feet to their back wall. Yeah, that's what we use. Okay, so it's not rational, but I assure you that appraisers are not just oblivious to where the market is.
Right. All right. So let's see here. I'm going to hit this question just because it's really easy. Can you remove the cost of the remodel? So when you're talking capital gains, out of the gain, yes, you can. Any improvements you've done to the property, you can take that cost out of the gain on the property, along with any cost to sell the property. There's certain fees that you can reduce. Take out there. So there are some deductions that come out of that. Again, talk to a CPA, tax advisor on that front. Just make sure.
And really what Jeb's talking about there is you're not taxed on the difference between what you owe and what the home sells for. You're not taxed on what you paid for the home and what the home sells for. You're taxed on the difference between your basis, your taxable basis, and what the property sells for. And all of those things Jeb was talking about, a remodel, adding a pool, all of these things can be added to basis. Some costs of refinancing can be added to basis. If you had ever rented it out and depreciated it, that could be a deduction from your basis. So this is why Jeb's saying, talk to your tax professional. They know your situation. They can help you calculate your basis. And hopefully if you've been there a long time, you've done some things to the property, you have good records for that. So you'll be able to accurately calculate your basis.
All right. Marta is asking, can you help me refinance? Have a single family. I'm in San Francisco. Never mind. Have a lot of equity. Want to fix my roof? The answer is yes. I'll throw Josh's information up there in a minute. You can contact him. But she does go on to ask a question here. Better to refinance or an equity line of credit? Josh, what are your thoughts on that? I know we've touched on it many times, but let's
go back to my saying that numbers never lie. You need to do a side-by-side comparison. So if you have a 2% interest rate on your first mortgage and you want $50,000 and it costs 6% to get that in a HELOC, then we would want to calculate what's the blended rate of that. Because you have a very low rate on the first mortgage, you probably want to keep it. If you have a 3% rate on that first, or a 2.75, and you're borrowing $100,000 out of your house at 6%, that blended rate is going to be higher. There's other things that come into play. The HELOC's always going to be a variable interest rate. You have an interest-only period before a repayment period. You don't have to start paying interest on it until you borrow the money off of the line of credit. So there can be reasons for doing it. But I'm going to say, of everyone that I talk to that's saying, I want cash out, let's look at a HELOC, let's look at a cash out refinance, it's probably 70% plus of the time, probably more like 80%, the cash out refinance makes more sense than the HELOC.
Good stuff. Logical Thinker has a good point here, something we've actually talked about, Josh. The Fed has retired the word transitory and not thinking about raising rates till 2024, that whole statement. So do you think that rate hikes may lead to a recession?
In the discussion that we just had 10, 15 minutes ago, I think Logical probably popped in here a little bit late. There's exactly that risk. Yeah. And we're talking about the Fed doesn't have a lot of good options. They cannot not do anything. What they're doing is putting gas on a fire. And we're seeing, are they responsible for 10% of the inflation we're seeing? 50% of the inflation we're seeing? I don't know, but their actions have definitely increased the inflation. So they don't have the option of not doing anything. They have to stop buying treasuries. They have to stop buying mortgage bonds, and they have to get rates off of zero. Now, doing that, could that push to a recession as supply chain normalizes, the stimulus works its way out of the economy, and there's no extra money floating around buying stuff? Absolutely, but time will tell.
Time will definitely tell. And to answer your question, Alex, see the news report about the African-American couple claiming their appraisal came in low 10 months prior to their last one due to racism. I saw the headline. I didn't read the article. So I don't have any thoughts on it. I did see, again, the headline, but that was all I read on it. Raul says third month off forbearance in January. When can I start the refinance process? So when you're coming out of forbearance, you need to make 3 on-time payments in order to do a refinance. Raul saying is his third payment's going to be due in January. So as of January 1st, assuming he makes that payment, he'll be in a position to refinance. Can he start that process now, Josh, with the idea of closing after that third payment's been made?
Several of the people that we've talked to, we've done exactly that. We start, 45 days before that third payment's going to be due. You can't make the payment early. You can't just roll out 3 payments and go, there's my 3 payments. But you can do them over time, and we can absolutely start and have your loan approved, done the appraisal, everything sitting there waiting just until the month rolls over and you make the payment.
All right. Krasimir has an interesting point, or an interesting statement. I think about these things too, right? So it says the Fed has given themselves an out with Omicron. Rates not rising, home prices go up, inventory too low, right? There's so much happening at the moment. I think there's several outs for the Fed not to do anything. But fortunately, that news has been out, and they came out and still did what the market wanted them to do, which was, get shorten the tapering, let's get through that process, get done sooner rather than later. And the market reacted accordingly. So I think they're doing the right thing. Now, if this goes into full blown problem, here in the state of California, as of today, actually, we're supposed to have masks on, Josh, inside.
We're inside. That's correct.
So yeah, here in the state of California, as of today through January 15th, we've gone back to a wonderful mask indoors. So if you go anywhere indoors, you're now supposed to wear a mask regardless of vaccination status. So yeah, that's a whole different conversation. But yeah, I think if it did become a big problem, the Fed will probably do something, right? They're going to stop the stop of tapering. I mean, there's going to be a reaction.
Think about this, Jeb. That's why they have to start and aggressively pursue it, because there's no bullets left. They have no ammunition. So yes, by stopping the QE, by increasing rates,
they have an opportunity to come back to it.
That was their whole big rush in 15, 16, 17 to raise rates as quickly as they could without stalling the economy, so that they had something that they could do when the next crisis, aka COVID, which no one saw coming, actually came around, and they were able to cut rates, and they were able to go back to buying bonds.
No, absolutely 100% agree. And somebody made a comment on one of my videos yesterday that something I've also considered, and that was that the idea of these moratoriums, if anything ever happens in the future again, there's this expectation almost that a moratorium, like you have to do a moratorium, whether the government believes that or the Fed believes that or the people, which I think is probably more who would expect it to happen, that there's this idea that you have to do this because we're affected. And that's the world that we've created at the moment. And hopefully that's not something that we continue to see in the future. But, expectations, I bet a lot of people would expect it to happen. So anyway.
And you look at it, Jeb, it's interesting. I can sit here and bitch and complain about it because the way it was done, it led to severe negative unintended consequences. The majority of people, so remember, it's survivorship bias. So the people that I talk to, the ones that are calling me and want to refi, almost all of them had no need to be in forbearance. You were supposed to attest that you had a hardship that made it impossible for you to make the payment. 80% of them had no hardship, never missed a day of work, no problem. And they say things like, well, I used it to pay off my credit cards. Oh, I used it to build up my savings. It was not what it was for. It put lenders in a bad position to help the people that needed it. So I have no doubt there were plenty of Americans out there that needed it. But most of the people that I'm talked to a gentleman from your YouTube channel yesterday that took a forbearance, it's a VA loan, and the lender decided to give him a loan mod. It didn't improve his terms. It saved him $20 a month on his payment. It makes it so he's not behind. There's not this forbearance balance sitting on his statement, but now he's 6 months out from being able to refinance, and he didn't need to do it. That's the majority of the people I talk to. So now contrast that with 2008, 2009, 2010, when the government didn't tell lenders anything, and the lenders came back basically with double birds, let's get it in frame there, to every homeowner saying, we can't help you, or hey, send in your paperwork. So we had the opposite, like it was way too flexible here, where people got helped that didn't need help. And then we had 2008, 2009, 2010, where no one got help regardless of how badly they needed help. There's an answer somewhere in the middle, and it's not just better for consumers, homeowners, it's better for the lender also. The outcomes from 2008, 2009, 2010 were far worse than they needed to be because of their insistence on giving the double birds to homeowners versus stepping in and helping. So long way of saying, hopefully there's a middle ground going forward where the strong arm of the government can convince lenders to be a little more flexible and accommodating without going as far as we did in this last go around.
Agreed. I'm going to hit this one because it's pretty easy. What's your take on real estate in Katy, Texas? I don't have one. I don't know the area, but I do know agents that work the market there. If you need somebody, reach out. Happy to put you in touch with them. We'll throw a link on the screen here momentarily to get you in touch with somebody if you need that. Love Supreme asks, how will your prediction of interest rates going up impact multifamily property sales? So Josh is, again, if you're just coming into the show under the belief that rates really aren't going to move very much. And I've said if they move, they're not going to move, again, more than probably 0.5% in either direction. I don't think you're going to see rates, at 4%. I think probably 3.75 is the high side of that. But even with that said, let's talk about multifamily, because multifamily is a little bit different animal. Residential real estate is an emotional buy most of the time, right? It's an emotional process. You buy emotionally, you justify logically. Multifamily typically is a little bit more of a pragmatic approach, right? Because it's an investment in many cases, right? You've got other units in that property. Does it cash flow? Is there a cap rate? What's the cap rate? It comes from that side. Now, in that case, I don't know. Raising interest rates affects that cap rate, right? It costs more money to service the debt on that property, which means that you're going to bring in less money. But at the same time, you've got, potentially a rental market that's going to be in high demand for years to come. You're going to be able to continue to adjust values up, monthly payments up, which may or may not bring that cap rate back to where it would have been otherwise. So hard to say. I don't really think you're going to see here in Southern California, you're not going to see a big change. There's not a lot of multifamily out there available that really, I would say, makes sense price point wise, because it's just gone bananas. Unless you put a huge amount of money down and or you're living in one of the units and renting the other three out, it's really hard to justify some of these numbers because of where prices have gone. I think there's better opportunities in other states, whether it's single families or what have you. But at the end of the day, I don't know that it's really going to change much. I don't think interest rates are going to move enough to really hurt that segment of the market. Josh?
No, same. The big thing that we're seeing is the numbers don't make sense for someone entering the market. You would have to put such a big down payment, and there's such better options for getting yield. I mean, buy a single family and pay cash for it before you put a $400,000 down payment on a $2 million property that's not really going to cash flow all that well. But how do interest rates impact it? Exactly as Jeb said, it makes those numbers worse. So largely, what are we seeing? Most of those $2, $3, $4, $5, $6, $10 million apartment buildings are exchanges. They're selling to people exchanging from another property, rotating up. Obviously, on the lower end, someone has to be buying those lower end properties as a first-time investment. But for the most part, it's people exchanging into a new property. Where in the hell else are you going to have that giant down payment to make the numbers make sense?
Well, that's a question that I want to touch on here. So, SMAC or SMAC, I don't know. Rental in Arizona, thinking of selling. Is that a good idea? Sell and do what, right? Our comeback to this question is always sell and do what? If you're selling an investment property and you're not buying another one, and it's in Arizona, chances are you've made equity on that property. You're going to pay capital gains on that gain of that property, if there is one, right? If you decide to 1031 it into another property, where are you going to 1031 it? I have clients right now that put an unsolicited offer in on a property that's an investment property. The seller was considering it until she started thinking and going, okay, if I sell this investment property, it was a $1.3 million. If I sell this investment property, what the hell do I do with the money? There's nothing to buy. There's nothing out there in this market that I want. And even if I did, I can't find it. And so that's something you have to consider, right? So if you are going to sell it and do a 1031, can you even find anything in the time that, that you have 45 days? You have 45 days to find a property or find several properties, if you will, in order to do your 1031. And then you got 6 months to close on them. So can you find something in that short period of time? I don't know, right? I mean, that's the question that you have. And if you're selling it because you think you're at a peak, I think there's still a lot of people that want to live in Arizona. I still think there's a lot of people that want to live in Boise. I still think there's a lot of people that want to live in Austin. I don't care what the values have done. I don't care about the appreciation. I'm just telling you, there's a lot of people that still want to get to those areas and haven't been able to do it. So I think values probably continue to increase for some period of time, but that's just my thought. I'm not in those states. I'm in Southern California. So that's where I'm at with that. Josh, thoughts on it?
No, same things. I don't know if you saw the headline. Someone came out with their most overvalued housing markets article today, and I
was it a YouTuber?
It was not. It was not a YouTuber. It was an actual news website, and they didn't tell me why. I mean, objectively, what criteria they were using. Don't tell me, because it's the market that appreciated the most. And you mentioned Boise, you mentioned Austin. They were both on the list, and you're like, okay, do either one of those areas have a supply of homes coming online that's going to increase the supply demand imbalance? Because that's what impacts prices in the near term. But I bookmarked it. Maybe we can talk about it next week when we come back on. I want to know what criteria they're using, because literally they said Boise was 81% overpriced. So I was like, so you're projecting that they're going to correct by 81%. You're like, you realize that's crazy. So we'll dig into the numbers and come back with it. It's clickbait. People love hearing it. People in Boise who don't own a home love hearing the homes are going to come down 81%. So it's just I'll dig into the numbers. There's companies that put out it's like it's renter porn is what it is, so that someone can feel good that there's going to be this big opportunity in the near term future. Jeb sent over the article of the guy, year one of a 10-year boom. I don't think we have a 10-year boom ahead of us, but 3, 4, 5 years until we get through all of the millennials getting the homes they want, until the builders get through the building run that they're going to do. Because when the numbers tell them, hey, we've underbuilt, there's a 4 or 5 million undersupply of homes, builders are going to build.
For sure.
But it's going to take time to fill in that gap. So we get to the tail end of millennials in their prime buying years. Builders are pumping more homes in there. Economy's in a totally different spot. I believe before 10 years are up, we will see something happen in the market, and we will see some type of correction. But I don't see it on the horizon. Our best bet, what do we talk about here, Jeb? We want to project 1 to 3 years into the future. And if you're a buyer, we want to have a horizon of 5 to 10 years. It's really hard to get bit in the 7 to 10 year time horizon.
Yeah, no, agreed. 1000%. It's again, it's hard to justify what's going to happen, in 5, 10, 7, whatever the number of years is, at the end of the day. And people, if you can afford to make your monthly payment and you are going to, be in that property for a 5, 7, 10-year horizon, you're in good shape. That's what I believe. I truly believe that. And I'm not here, getting you to buy a house. I don't care if you buy a house, quite frankly. I think it's a good idea for your net worth long-term to do it. But I don't, I don't benefit from 99% of you, 99.999% of you buying a house. I'm just here to try to provide some logical information so that you guys can make the right decisions. And yeah, I do think until something happens with new construction coming in and building homes. I mean, even if builders, I mean, Josh, we've talked, even if builders wanted to build homes, we know there's an undersupply of homes. Builders know right now they could benefit. They can't build them fast enough. There's so much like legality in the way, especially here in California, of being able to develop property, for one, because of all the craziness that goes on and all the stipulations and requirements and all of that. But there's a lack of land. There's a lack of supply of wood. And even though lumber has come back down, there's still there's issues in the bottleneck, so to speak, that's going to take years to work out. I mean, again, I've talked to people in the car market, right? You would think it would be pretty easy to make a chip, right, for cars to be able to produce these cars. I've talked to several people that understand the car market, and they're in the car business. They're saying this is a 2 to 3 year deal to get this thing situated. And so that's just a chip. We're talking housing here, people. It's a whole lot different process. So anyway, thoughts on that. Tim says, longtime fan of you too. Great channel. Keep up the good job. Thank you, Tim. We appreciate that. Who is giving money?
Whoa.
Hey, calm down, Jennifer Lego.
What is going on? We got a big spender in the house.
Yeah, we do. Look at that. $50. Holy cow. That's a lot of 805, Josh.
If I ever could see it.
No, you're nursing a wounded arm. You shouldn't be drinking.
Until we're healed. I'm at week 5. At week 12, I'm supposedly healed enough so I better get a gallon or 5 gallons of 805 at that point in time.
Jennifer, you are more than, I mean, that is very, I'm grateful for that. You're awesome. You do a lot in here. I'm going to buy you $50 worth of like something. It's going to show up on your doorstep.
I've got a good one for $50. You're a little late in the cycle for it, but I'll send you the link. You can order it and send it to her. She'll love it.
Oh God.
It's not a pony keg of 805. Don't worry.
That would be very expensive to ship. It would cost me $50 just to get the shipping on that thing. Let's see here. Where were we before I went to that?
There's a very interesting question right here. I want your take on it. So Prati Logan says, what is your opinion about manufactured home on its own land without an HOA in California? Will it be a good investment for the long run? Will it appreciate? And before you answer, I want to just spell out for people. I get this question all the time. In California, most manufactured homes are in a park, and you lease a space, and your manufactured home or mobile home sits there. Never a good investment. It's just a piece of property that you own that depreciates, and you're going to end up paying more in rent. And because it's not real estate, you pay a higher interest rate to finance it. So what we're talking about here is you buy a piece of land, then you go buy or finance a manufactured home and put it on it, or buy one that already exists, a manufactured home permanently affixed to the foundation. So you're getting a real estate mortgage loan. The only difference is, rather than someone coming in, a contractor stick building the home, a seller of manufactured home comes and installs it on the lot for you. So that being said, what are your thoughts, Mr. Jeb?
Honestly, I would be an awful person to answer this question just because I don't do a lot of them, right? I mean, anything that I've sold manufactured wise is in a park. It has an association, typically a land lease, right, associated with it. You don't own the land in those. There are some parks in Southern California. My wife's grandfather was in Irvine in a park, in an awesome park, in fact, where the owners actually own the land in there and had amenities. They did have an HOA, but they owned it, so you didn't pay that land lease fee every month. And those cases, those appreciated, and they appreciated like crazy, especially over the last couple of years. So I do think you'll see appreciation on something like that, just because you own the land. The value's in the land most of the time anyway, whether it's residential and or manufactured, anything, the value's in the land. Now, if this is in the middle of the desert, probably less likely to appreciate. But if you're in an area that's somewhat desirable, there's growth in that market, there's people moving there, people wanting to live there, that's where you would see the growth. If it's completely rural, it's harder for me to really tell you one way or the other, because I honestly don't know. And it's hard to say without really understanding that market. I'm from North Carolina, right? So in North Carolina, where I'm from, rural North Carolina, there's mobile homes on land everywhere, right? I mean, just out in the country, people own the land, there's a mobile home. Now, those probably don't appreciate quite as much because there's so many of them, right? There's an oversupply of those in North Carolina. In California, it's not as common. So I think you have a better opportunity for the land to appreciate. But again, I would say talk to a pro that does that sort of thing and really get their take, because I'm probably not the best fit for that question.
And I would say a good example of this. So I had my shoulder replaced last month. Did it at the University of Washington. Stayed with the in-laws in Olympia, Washington. It's an hour south. And one of their neighbors cleared their lot of trees, which I had never seen their house. And I said, "Hey, Bob," that's my father-in-law. I said, "Bob, is that neighbor? Is that a new manufactured home they put over there? I've never seen it before." He goes, "No, they just cleared all the trees off their lot because they're putting a big shop." I said, "Well, cool. So when did they put it in?" It was about the same time we built our house, and it's a nice neighborhood and it's a nice manufactured home. Like, you're not tricking anyone. No one's going to look at that and say anything other than that's a manufactured home. But I will say that you want to talk about YouTube channels, there's some YouTube channels of manufactured homes, and some of these are amazing. And some of them go a long ways to disguising that it's a manufactured home. You're not really going to trick anyone, but they look much more like a stick-built home than otherwise would.
Joshua Tree. Yeah. So, I mean, if that's the same question, so is it Joshua Tree? No. Okay. Never mind. Somebody threw Joshua Tree down in the bottom in the comment. So I thought maybe that was the same person making the comment, but it wasn't.
Well, Joshua
but
Tree,
if it was Joshua Tree, desirable area, I mean, that's a market that you probably could see some appreciation.
Crazy market, and you could see that. And the other thing I would say, like an example, is just, is it common to the area? Like Jeb said, is it overbuilt to the area? You own the land, you're going to be able to take tax deductions because it's owned real estate. So I wouldn't, if you were in an area and in a price range and you got priced out of stick built homes, you said, I can buy a lot and put a new manufactured on it, or I can buy a manufactured on a lot that I own, I wouldn't hesitate to do it. I would much rather see someone do that than rent. It may not be as good long-term as owning a stick-built home, but it's going to perform much more similarly to that than not owning a home.
All right. So I got a couple questions for you, Josh. One is fresh fish. Say that 3 times fast. I was going to try it, but I decided not to. Any suggestions as to good podcast YouTubers for macro insights? Watching the macro and real estate correlations is super interesting. Thanks.
Most of the folks on YouTube talking about anything finance related are, all hat, no cattle. So I don't, when I go to YouTube, like I just said, I'll watch the channel on manufactured homes. I won't go into why I do, because it amazes me how nice some of them are. I watch the channel on Toyota Tundras. I have a Tundra, so I see the new one coming out, all the cool things people do to them. I don't go there for the super serious stuff. You've got our email address if you want to know some of the sources that I read, that Jeb reads. We'll both just hit us both an email. Yeah. We'll reply to you some of the sources that we like to check.
Yeah, but podcasts obviously a lot better fit. I'm a YouTuber that doesn't watch YouTube, and that's crazy to a lot of people, right? I don't watch other people's content for the most part, especially when it comes to housing and real estate. I mean, there are some that I watch just because I respect them in the business. But other than that, I don't watch a lot of YouTube when it comes to housing stuff. I watch a lot of, hey, how to fix this or how to do that, or like, the new phone coming out or the new car coming out. I'll watch that sort of thing because it's a little bit more interesting. I watch Mr. Beast, in fact, because my kids love him. And so I watch some of that content. But anyway, that's all good stuff. Question on a VA loan here. This is the other question I mentioned. Bought lots rental in 2021, but VA only counts current liabilities, but not rental income. Any special trick to qualify current incomes if not on previous tax returns? So the way I'm understanding this is, bought them in 2021. They're not showing on taxes yet. Is there a way to use those incomes to qualify?
And Han, the question I have is bought lots rental, or did you buy lots for a rental, or you're saying you bought lots of rentals? Bought
lots of rentals.
Several rentals.
Yeah.
Honestly, Han, I want to get you an accurate answer to this, but I would have multiple questions back and forth that we probably don't want to go into here. Shoot the emails up there, Jeb. Definitely send me an email. Myself, Lori, my favorite underwriter here, will get you an accurate answer and let you know if there's any way to make it happen. But it's going to require a little bit of back and forth that we can do in email or by telephone.
All right, good stuff. Let's see here. Everyone says 2 years out. We're dandy. What about 5 to 10 years? My loan is a 15, 30 years out. Buy to rent and don't sell on run. And no, even people need to pay off the government spending. So, yeah, 5 to 10 years. I mean, I do think, like Josh said a moment ago, at some point you see a correction in the market. You can't continue to have year over year growth. You can't. I mean, even if it only increased by a little, at some point you've got to have some sort of moderation. It's like a stock, right? It's not like a stock, but it's like a stock. You can't go up forever. At some point, there's a pullback, some leveling off, and then you continue that acceleration or deceleration or whatever. So at some point, yeah, you're going to see a pullback, and it might be 20%. It might be, but it might be 30%. But is it 30% from another 30% higher, or is it 30% from 50% higher? Is it 30% from 10% higher after we just went up 20? Who knows, right? And it might not even be 30. Maybe it's just a 5 or 10% correction in the market. It's impossible to say what's going to happen. There's a lot of crap going on, right? The economy, while GDP numbers and inflation numbers and all of that are great, I think the economy is still a bit fragile. I mean, quite frankly, right? I mean, it's running on a bit of air to some extent, right? You've got equities that are inflated because of many reasons. That's giving people a lot of buying power, a lot of a mindset, in my opinion, that thinks things are maybe a little bit better than they are. Just me. You've got, just got a lot of things that play into the reason that we're here. $31 trillion in debt that at some point I think has to get repaid, or maybe we just continue this. I don't know, right? And if that becomes, what we have to deal with, then I think there's got to be some sort of pullback to deal with that. But that's why it makes sense, and it's a must that you have a little bit longer term horizon so that you can, so there is some years of appreciation, maybe some years that things pull back, but at the end of the day, you're good, you're comfortable with your payment, you have some money in the bank. All of those things matter. That's why we always talk about them.
Look at it this way. Almost everywhere. So in Southern California, we're blessed or cursed, depending on how you look at it. If you own real estate or don't own real estate, you're going to look at it differently. That homes appreciate about 6 to 8% annually over the long haul, going back to the 70s, even with the big dip in 2007, 2008. So if you put 10% down, you got 10 to 1 leverage. So that market, so $500,000 home, you put $50,000 down. If it goes up 8%, it went up $40,000. You got nearly 100% cash on cash return. Now that decreases over time as you're building more equity in the home, you're less leveraged, but those numbers work everywhere. So if we say almost everywhere, home prices keep pace with inflation. So inflation 2.5%, 3% over the long haul. And that's what even very non-cyclical real estate markets generally appreciate at that level. If you put 3% down, that's 100% cash on cash return. 10% down, so 35% cash on cash return. And again, that decreases over time as you build up equity. But over a 10, 15, 20-year time horizon, you're paying down the mortgage, you're building up equity. You've fixed your housing cost. Rents will be more in 10, 15, 20 years, regardless of what happens to housing prices in that calendar year. There's a reason we talk about homeowners have 44 times greater net worth than renters. It's not magic. It's the simple math of home ownership, of appreciation, a little bit of tax deductions, fixing your housing cost, leveraged investment. You're using someone else's money to control a very expensive asset. So I don't worry at all about 10 to 15 years. We talk about, we the people need to pay off the government spending. We're never going to be able to. And the magical thinking, aka modern monetary theory, that one of our parties in Washington, D.C. subscribes to, says that you don't have to pay it. You just print money indefinitely. There are repercussions for it. The repercussion isn't what was generally thought, which was for 20, 30 years, it was, hey, you borrow all this money, it's going to be inflationary. It's the opposite. It's deflationary. And deflation is worse in the long run than inflation. Hyperinflation, where you get the situation in Germany where you need a wheelbarrow full of cash to buy a loaf of bread, yes, that's horrific. But deflation is even worse for long-term growth. So long answer to a fairly short question, but I wouldn't worry. I think owning real estate, at least your primary residence, is a key to building wealth over the long haul.
All good insight right there, my friends. So a couple people reaching out asking for contact info. Triton, Asking about Katy, Texas. You got Love Supreme asking about Raleigh, Durham. That's essentially not my home market, but about an hour from it.
How far is it from Kinston? 1 hour?
About an hour, hour and a half, maybe hour and a half, depending on where you are in Raleigh. But here's the deal. Throwing a link up there with some contact information on it. That jebsmith.net/referral is where you want to go. It'll link you to one of my experts. Yeah, I mean, this is something we put together. It's a lot easier to do it like this. Created this network of people that we know, like, and trust to do business like we do. Put you in touch with them. It's very easy to do. And, anyway, it'll take good care of you. And if you're bored with that, you guys can do me another favor and hit a thumbs up. How's that? How's that, people? Hit a thumbs up if you find any value at all in the comments at the moment. It helps more people see it, helps us get out there and accomplish our goal of helping more people, which is really what we're here to do.
Jeb, before we jump into another question, I want to share something here because I think this will be a nice discussion. And I think you guys will actually like it. So we talked about it was Fortune magazine, which is also turned into Clickbait. It used to be a real magazine. Now it's just they want clicks. But their number one most overpriced housing market is Boise, Idaho, at 80% overvalued. Without digging into the methodology, I can already tell you this is horse shit. Because they're saying this is the trend, the long-term trend, and we are currently 80% over trend. So, and that's based off of the average Zillow home value index and then their expected price. So this long-term trend is their expected price. So expected price, okay. Why is that a straight line? Does it not impacted by if incomes go up or down? Wouldn't the expected price of the homes go up or down? If interest rates go up or down, wouldn't the expected price of the home go up or down? So when you see headlines like this, you can't just accept the headline on face value. Look at Boise. What do I know about Boise being here in Southern California? Besides, I played a couple games at Boise State during my college years. It's a lovely, lovely town. I mean that honestly. It's a bitchin' little town. But beyond that, I know lots of Californians moving out to Boise, and they're not coming back. So when you say, oh, it's Idaho and they grow potatoes in southern Idaho and there's no one out there, that whole Boise basin is full of people now. Those people aren't coming back. So when people go there, what happens? Historically, we would say New York and LA had all the jobs. So high-paying jobs, desirable real estate, home prices go up. Boise is a pretty cool place to live. It's also desirable real estate. They're getting more and more industry, more and more jobs out there as people realize, hey, we have a smart, educated, young workforce here. So anyone that says, hey, this linear trend here of what home values should have done or should be doing is insane. The market has changed out there. The population has changed. And that's without even getting into the fact that this doesn't account for what's happened to wage growth, what's happened to interest rates, what's likely to happen going forward. So long way of saying, be real careful when you see these clickbait headlines and go, oh, I shouldn't buy in Boise because prices are going to dip. They could, but it doesn't have anything to do with this silly little measure that they put together here.
No, agreed. Here's an interesting comment. I'm going to work my way back up here because I'm kind of at the bottom here, but we will get to your questions if you put one in. So Conrad, so bought my first home, had to pay $105,000 over appraisal, not over the asking price, over appraisal. Now I feel like I made a huge mistake, especially with all the new expenses, tree removal, washer removal. Is this normal? Yes. Many ways it's normal. Some ways it's not, right? Clearly, the appraisal, whether it was right or not, you paid more than the home is worth. Buyer's remorse is a real thing. You just bought a very expensive property. I mean, even if it was $100,000, that's an expensive property, right? So you bought an expensive property, probably took money out of your banking, checking, savings accounts in order to do it. That money you feel like has disappeared to some extent. It's normal to have those feelings. It's like buying a new car or whatever. You have that remorse, right? As I mentioned earlier, people buy emotionally and then they justify logically. Now you're starting to think probably a little bit more logical after it's closed. At the end of the day, it's a done deal, right? So look forward, make your payments, a couple years, probably be all right. But yeah, it's normal to have some sort of regrets. I mean, I think anybody buying any house, even if you absolutely love it, you question it a little bit. And I have that conversation with clients all the time. Like, listen, here's the deal. You're going to get your offer accepted after getting, missing out however many times, and you're going to be super excited. And then about 3 days later, you're going to go, what did I just do? And I can tell you it's normal. Everybody goes through it. So just, at this point you're close. So let's just continue moving forward. All right. What do we got here, Josh? I kind of went up. I saw something about a FHA. Here we go. Elara. Why do sellers look down on FHA loans? Josh, why do sellers look down on FHA loans?
So from our end, why do people use FHA loans? Because they have less funds available, likely have lower credit scores, higher debt to income ratios. We have more flexibility with an FHA loan. So from a seller's perspective, you might rightfully conclude that it's a riskier loan, less likely to close. From a seller's perspective, what they should be concerned with is, does it close, and does the lender's money from the loan and the buyer's money from their down payment go to escrow and get transferred into my account? The reality is they're also wanting to know what is the most likely to close. And the easiest proxy for a home seller to understand is, how much money are you putting down? So FHA is very low down. FHA is likely, I mean, it's just the reality of it. If we look at median credit scores for FHA loans, they're about 70 to 80 points lower than a conventional loan. So lower credit score, lower down payment, those are the two big things the seller is looking at when trying to choose between offers. So in a normal market, when they may only have one or two offers, no problem. FHA buyer, you're pre-approved. That looks awesome. In a market where Jeb has 14 offers on a home and 2 are cash, 3 or 4 of them are 30 to 40 to 50% down. They all have 800 credit scores. It's just, you can see why a seller may look down on it. Now, the other variable, big thing we want to throw in there is, what happens with the 3.5% down loan when the appraisal comes in low? Most FHA buyers don't have the money to cover a shortage on the appraisal. And if they did, it doesn't take much of a shortage on the appraisal to eat up that entire down payment. You're probably putting 3.5% down because you have 3.5% available. If you had 10, you'd be going conventional. So concerns about the appraisal and just concerns about it closing are the biggest reasons why sellers would look down on them, despite the fact that they're very good loans. And once you are pre-approved, it should not matter. So with that, if Jeb has a buyer that we have pre-approved for an FHA loan, we are going to follow up with that listing agent and just stress to the extreme they've been fully vetted. We have a complete pre-approval package. It's been through underwriting. It is going to close. And even that is not a guarantee. Again, someone else walks in with an 800 credit score and 50% down or a cash offer, we still may lose. But we'll get those people into a home. It's just really important that you have someone on your team that's able to go above and beyond and go the extra mile, because there are some negatives that come with that FHA financing.
Yeah, two things you didn't touch on that I want to point out. Sometimes if you have a property that needs a work, appraisers on there, they're not doing an inspection, a home inspection on the property, but there are things that they have to point out in an appraisal. If some properties don't have heating or furnaces, or maybe there's lead paint or peeling lead paint or peeling paint at all or whatever, they point out those things. So in that case, that might be an issue. The other thing is, FHA, you can't truly waive the appraisal. And so our residential purchase agreement here in the state of California is new as of this past Monday. So the 14th, it came out. It's been the first major revision of the contract in 21 years. And in that contract, something that I've been talking about for the last year is, and quite frankly, a lot of real estate agents probably don't even know this, because there's just a lack of understanding surrounding it. But you can say, hey, I'm willing to waive the appraisal, and it's an FHA loan. But the FHA and a mandatory clause basically says, no, it still supersedes the fact that you decided to waive that, and therefore you can't really waive it. And that could be a reason that sellers look down on it. On the new residential purchase agreement, the reason I brought that up is because it does state that if it's an FHA loan, it talks about the appraisal on there and not being able to not necessarily waive it, but it does address that question up there so that sellers know, hey, the appraisal is still something that needs to be considered in this process. So, all of the things Josh said are absolutely accurate. Just because, there's sellers and a lot of agents, unfortunately, are misinformed when it comes to certain types of loans. And it's no fault of their own in many cases. There's just this general consensus that's out there that the loans aren't as good as other types of loans for whatever reason. And that's why working with a pro, having somebody try to convey how well qualified you are may help you in getting to the finish line. So that stuff matters. Anyway, we're going to read Willing's comment because every time I try to read it, it just like
makes your head hurt.
It does. So Doge betrayed him. But I did see that Elon is now accepting it, so you can buy a Tesla with it if you'd like, Josh. So if you can get in there and get it. He says, I'm glowing tonight. Lewis UCDP is finicky. And he's asking how you wrestle with it, like an alligator or a fuzzy daffodil. Navigate water or be a flame. Geez. You know, we're going to have you on the show one day and let you do this whole thing. I think this is you're way more entertaining than Josh and I. Let's see. What do we got? Here you go. Nina is saying, my agent is contesting appraiser report in Connecticut, coming out $10K lower than amount agreed upon. What are the chances this would work? I don't know if it's 50-50. I've had appraisals overturned in my career. FH or VA appraisals, a little more easy, a lot easier to do. There's an actual formal process to the process of rebutting an appraisal. Whereas conventional and FHA, it doesn't go that direction. So, you know, probably 90-10 that you can get it done. It might even be higher the other way. I mean, the other way.
No. You're about right. I would say about 10%.
1 out of 10, maybe you can get the value changed.
We've got 2 corrected this year, and both of them, it wasn't as simple as the rebuttal process. Is there's a form. This is the most important thing that I tell people. And I say this with all kindness towards realtors. The majority of realtors don't understand the appraisal process. So appraisal comes in low. Listing agent loses their shit and says, I had 97 offers. This is absolutely worth this. Okay, cool. Show me the closed comps that support this value. And I'm not kidding you, 80% of the time, what I will get is an email with pending comps 2 cities over, comps. We had one this year. It was a duplex. They had a comp of a fourplex that was sold for like $40,000 higher than our appraised value. Like, what do you think this supports? So that being said, I always start by asking the listing agent and the selling agent, do you guys think the value's there? What closed comps support it? Can you please get me them? We get them, and then we look at them, and then we go back to them. Hey, this doesn't appear to support it for this reason, this reason, this reason. Oh, okay, well, what about this? When it makes it through that, I'm going to say we've probably done 5 or 6 rebuttals this year. So maybe the number's higher, Jeb. We've had 2 successes out of 6 or 7 this year. For the most part, with the new process of an appraisal management company being in the middle, the appraisers are firewalled from it. They can tell you to pound sand, and you better have a very, very strong amount of evidence that they're wrong. One of them we did. The guy came back. He said, pound sand, I'm right. Went back to the appraisal management company, went back through it with their head appraiser, and he goes, you're absolutely right. These are the right comps, the wrong adjustments. They went back. Magically, dude comes back with a $73,000 higher value. That was the biggest success we've ever had on a rebuttal. We had another one where we needed about $5,000 to make the deal, and we arm wrestled with them, and they gave us $5,000.
No, good stuff. Good stuff. Let's see what we got here. Nina is saying, please click the like, guys. So click like if you haven't done so already. It helps us.
I'm not laughing at you. We got some great advice, Jeb.
Hold on. Which one?
The YouTube car spotters guide pointed out quite astutely. I actually saw my first 22 Tundra. I had to pick mine up from the dealer today. We're getting a little service because we're heading out on that road trip next year. And there was one sitting there, and it was gone before I went in to pay to get my keys back. And I come back to take a picture of it, and the thing's gone. So unfortunately, the 10 to 15 markup is easy. They also, this will mean nothing to anyone that knows nothing about Toyotas, but they have a TRD Pro 4Runner on the lot, used, 2 years old, with 25,000 miles on it, that for $75,000 you could have. So 100% correct. Be careful of buying a car, and don't do it unless you have to. Jeb's not going to. Jeb's going to drive his car for 34 years, or until prices get realistic, or his
No, until
Rivian
my
shows
car
up.
comes in, bro. I'm gonna.
Until your Rivian shows up.
Yeah,
That
it's
might also be 34 years though,
it's
Jeb.
on order. It's been on order for a couple months now, and what was supposed to be January, I think, is now looking like probably January of 2023. I haven't gotten the official notice yet, but even then, you could probably add 6 months to it. Oh, geez. Yeah, I don't know. Anyway, I need a new car.
If you want to stay on Tundras, Stefan says that he's going to get one. He sold his 06 double cab, and he's waiting for the hybrid, which we can't get until March. That'll probably have a $25,000 dealer markup on it.
All right. No. Good stuff. I was reading a comment. Sorry. Let's see here. Klar, want to buy a second home out of state. My wife and I have a lot of student loans. Is it better to rent the first to help upset the debt to income? So, Josh, I mean, so I guess the first question is the second home a true second home, or is it a prime? It sounds like it's maybe going to be a primary out of state. It's going to be your new home that you're going to live in. So answer that first, and then we'll get back. But if that's the case, then yeah, you probably want to rent it out. Will definitely help your debt to income ratio. I mean, that's the easy answer to that question.
The student loans, I'm assuming, hoping you're already in an income-based repayment. Even if you don't want an income-based repayment, you're not in an industry where public servant loan forgiveness is available. You can put it into an income-based repayment just to bring that payment way down to qualify. So renting out the residence. So if you're buying a home as a second home, renting or saying you're going to rent the departing residence, it has to make sense. So if your jobs are in LA and we're buying a condo in Miami, we have to know how your income is going to transition there if we're going to rent the departing residence. So a number of questions there. You guys have our email address. Shoot it over to me. I'd love to go into a little more detail on it, but there's a few options there of what you can do. If you're in California, we can help and get you a full pre-approval. If you're outside of California, we can get you connected to someone that's familiar with the student loan guidelines and buying second homes, because it's a little bit complex. There's a lot of moving parts there.
All right. So I've determined that Willing 7 is actually Lori. I mean, he says that, or she said, mortgage processing is like kayaking. You stop paddling for a second and you will drift and wind up in a tree. Luis got me an Xmas gift, a Christmas gift. He is actually a good guy behind all of his slithering ways. So you only have one underwriter. So that's,
hey, before,
maybe it's Rick.
It's more likely to be Rick, but before you compliment him too much, he said he'd like to catch you in a back alley.
No, he's Miss Lego. He wants to catch Miss Lego in a back alley.
He says, I'd like to catch them in a back alley. He was telling
Jeb is the best at what he does.
That he wants you, when what you do isn't very nice.
He said, mi tango, mi gringo, my gringo. Fucking guy. Geez. Let's see what we got here. Go ahead.
What was I say? Eli has a wonderful chef's hat there in his picture. Why isn't loan processing fully automated? So painful. Anti-money laundering, know your client. It's not even really about the anti-money laundering. It's that the system's not ready for it. It should be. The technology exists. It should be. But what do we have to get in? We got to get income. We got to get assets. The credit part is automated. The underwriting is automated for the majority of clients. But processing, gathering the documentation. We use a point of sale system that if I send it to you, you can authorize it to provide all of your banking information. So you don't have to do it. 1 out of 100 clients will do it. And most of them say, I'm not giving you my login to my bank. So I didn't ask you to give me the login to your bank account. I'm asking you to authorize it to give me the information that we need. So there's just a lot of resistance from consumers. And it's sort of like if you go back to 1998, people are like, I'm not buying stuff online and giving people my credit card. I'm going to get all my money stolen. And now everyone buys everything from Amazon. So it's a matter of time of consumers catching up and being comfortable with it. On the income side, a lot of employers don't have payroll systems that are tied in a way that we can validate in an automated way. Now, the big one that I'm waiting for that will save everyone a huge amount of trouble is when we can tie in the tax return transcripts to our system, where it can just pull it in and validate and confirm that stuff on the back end. So really, we're just catching current pay stubs. But it's just the technology and consumer preference of not being comfortable with using the automated pieces.
Awesome. Good stuff. Let's see here. Let's go with this one real quick. What's a good conventional loan credit score, Josh?
So the best is 740 for a Fannie Mae, Freddie Mac loan. Anything 740 and above will qualify you for the best pricing. Now, a lender can go above and beyond and say, hey, we want a bunch of 800 credit score loans and give you an incentive for those. But across the board, the Fannie Mae pricing matrix says 740. Anything 700 and above is going to get you good terms. Let's say 680 and above. Once you fall below 680, that pricing matrix starts getting a little bit ugly. And especially if you need mortgage insurance, the mortgage insurance gets pricey the lower you go on the credit score. But 740 is the best tier. 700 to 740 is good. 680 is okay. Below 680, you're going to start paying for not having such great credit.
Good stuff. And I didn't say thank you a moment ago to Kalar, who gave a super chat. So thank you for that. I didn't realize I didn't say thank you until I just saw the super chat on another screen. So thank you for that and the support. So very much appreciated. Another question while I got you here, Josh. What's a good debt to income ratio? We've talked about credit scores. Let's talk about DTI.
So what do we define good? To me, good is anyone that allows you to be approved.
Hey, I want to get approved. What conventional? Where do I need to be? Where do I need to be with FHA? Where do I need to be with VA while we're talking about it?
So back in the 90s when I started, we had these three-ring notebooks, big fat 3-ring D notebooks, and you would sit there and open them up and it would tell you at this loan to value, so with this much of a down payment, here's where your debt to income needs to be. The reality is they're all going through automated underwriting now. It's a little bit of a black box, so there's no way to tell you for certain. Conventional loan, the old school would be 28 over 36, 28% housing to income ratio, 36% total debt to income ratio. Even the worst qualified clients in an automated underwriting system will get approved with that. If it's going to approve it, it will approve it within the context of that. So almost all clients with good or better credit on a conventional loan will get approved with a 45% debt to income ratio. The best qualified clients, higher credit scores, more reserves post-closing, will be able to go all the way to a 50%. On an FHA loan, you can go higher, 46.99 on your housing to income ratio. Once we throw in all your other debts, 56.99. But again, that's black box. That's automated underwriting. It's going to be lower. If we need to do a manual underwrite, you have to stay under a 50%. And we've talked about this a million times here on the show. VA's nuts. As long as you meet the residual income guidelines and you have good credit, we can go as high as a 69 and change debt to income ratio. So what's good? To me, good is anything that gets you approved for the loan. If you're asking what's good for me as a home buyer, like some of this stuff, Jeb and I talk, Jeb's client that we did the financing for had a 69% debt to income ratio. 67. You sure it wasn't 69?
67. You just like the
scared
number,
me.
67.
I looked at it and it made me sweat going, how is my guy going to make the payment? But at the time he had a girlfriend who was helping out, but Jeb's told me he's since lost the girlfriend. That's the danger there in that situation. So what's a good level where you're comfortable? I don't know. It's going to vary based off of your lifestyle and how much money you spend that doesn't show up in that debt to income ratio. You know, I don't know that I would be comfortable personally with anything over a 40% housing to income ratio. Because remember, we're using gross income. You've got, deductions that are taken out of that. It's not the money that you're coming home with. So if your withholdings are 25 to 35% of your income, and we're at a 40% debt to income ratio, only leaves you about 25 to 30% of your gross income for your spending cash and paying all your other bills. So in a perfect world, if you could stay 35% or below on the housing to income ratio, 40 to 45 or below on your total debt to income ratio, that would be preferable. And the honest answer is what's good, as low as possible.
All right, there you go. This one's just a comment I want to read. Not to pat myself on the back, but I like it. Hey, just wanted to drop in and say thanks to Jeb and following your channel for the past year. Info helped us close on our first home in Lakewood in November. It was a journey. So congrats, Andrew. That's awesome. Another crazy market out there, Lakewood. Geez, that market's gone bananas. Keith said I had a title change and a refinance, and this triggered a tax assessment. The assessment came $100,000 and higher than the refi appraisal. Is this grounds for an appeal? So potentially, yes. So what happens is if you're in the state of California, which I'm assuming you are based on the statement here, maybe not, but whenever you do a title change on a property, you change the ownership, whether it goes into a trust, you add someone to title, any of those things, there's a certain document that gets filed that goes to the county that basically says why you did what you did. You're adding this person to title for what reason, or you're transferring title out of your name into someone else's name for what reason. And if the county doesn't agree with the one that you pick, there's a couple of options that don't trigger an assessment, then you'll get assessed. In fact, the last time I did a refinance, which was probably about a year ago, Josh, I put the property in my trust after the fact. Well, when I filled out that document, I basically said that I was transferring it out of, personal names into a trust, whatever. They hit me with the assessment. So I did the appeal process, and they changed it back. So in that case, yeah, maybe you didn't fill out the information correctly. Sometimes when you do fill it out, you have to explain exactly what happened so that they completely understand it. And if they don't, the easy answer is they adjust it, and you don't fight it, and they make more money. And if you do fight it, it goes to like a little appeals deal, and they decide whether or not it's actually necessary or not. So I would tell you, worst case is 100% do it, and hopefully try to get the assessment reversed. So for those of you out there in other states, you probably think are crazy, or that what are we talking about? But California, or property taxes don't necessarily go up like a lot of other states do every year because of certain measures in place. They can adjust, but not like everywhere else. Anyway, so let's see. Makeup Glam made a statement a moment ago. Finally got a cash offer accepted in Orange County, where we are, after 5 months of trying. Offered $20,000 over the list. After inspection, came back with $8,000 in repairs needed. Sellers won't help. I'm confused on what to do. So not really something I can give you advice on, unfortunately. You're in contract, you have an agent, all that good stuff. But what I would tell you, if I were talking to a friend, is that, are those things non-negotiables for you? You just paid cash for a property. So, the items that need to be repaired, are they cosmetic? Are they necessary? Are they health and safety? Where do they stand on your list of things being able to that you want done? Where's your line in the sand, right? I mean, negotiation is all about, figuring out your line in the sand, so to speak, and being able to stick to it, right? I mean, and at the end of the moment, you've put in multiple offers, you've gone 20 above asking price, they're not willing to work with you. Are there multiple offers on the property? Where's the next offer? Try to get some more information. Maybe your agent can find out some more information. Play hardball. And if you're willing to play hardball and you're willing to lose it, go for it. I mean, that's what it comes down to. I mean, are you going to be sad if you say, no, I want this stuff fixed, and they say no, and you draw a line in the sand and don't move forward? Are you going to have regrets over that? Because chances are that home's going to be worth more money. I don't even know what you paid for it, but chances are it's going to be higher value in a couple of months. So if you miss out on this opportunity, are you going to be able to find another one similar to what you like in that time frame? Or do you just pay $8,000 and get that stuff fixed? And where's the $8,000 number coming from? That's another question, right? Never expect, as a buyer, that somebody's going to fix everything on the home inspection, right? I mean, that's maybe at some point in time people did that. That's not reality these days. Typically a home inspector is there to find problems with the property. A lot of those are problems. A lot of them aren't real problems. More things that are pointed out, more code changes over time, more things that could be problems if things aren't done to prevent them. So is it really a true $8,000 number, or is it less? So Anyway, a lot of talking and not really giving you an answer, but I think your agent is there for a reason. Rely on them. They should be. I mean, you need somebody that's good at negotiating. Hopefully they are. That simple. Josh, let's see here. Somebody said front end or back end. I don't know which they were talking about there, but let's see.
Jennifer had another comment with her $50 super chat. She gets all of her comments answered. Says, Jeb mentions peeling paint a lot, must be a California standard. It is not. California is no different. We have, prior to 1978, paint included lead. If you have peeling paint in a child who likes to eat things, they can grab the peeling paint, shove it in their mouths, and die. So anywhere in the United States, home that was built pre-1978 and has peeling paint is going to be a problem for FHA loans, problem for VA loans. It could be a problem for other types of loans if we have an appraiser that just doesn't like the risk level.
No, good stuff. Let's see here. I'm not going to even comment on that. I could and really give my 2 cents, but I'm going to avoid it. Let's see. Closed on a house last month, 2.77 interest rate, 8% down, got the full $17,000 grant from the Bank of America. Thanks for helping on the journey, guys. 6 months from starting to close. 6 months from start to closing in Vegas. So congrats to you on doing that. That's good stuff.
Super congrats. If you can get free $17,000 out of a bank, or 17.5, whatever it is, it's real money. I'll jump through some hoops for that kind of money.
All right. Somebody's got a question here. Josh, more thrown your way. Dung. Let's see here. Did he ask a question prior to this, or is this the question? Asking if 4.37% is a high rate. That's all going to depend on a lot of factors, right? Go ahead.
So here, let's say what you said is 100% correct. And what are some of the factors? I just quoted a client, a longtime client, valuable client, VIP client that we love, 4.375 on his loan today. And what is it? It's a condo, non-owner occupied, in a very urban area, so super high values. I didn't say urban in a bad way. It's a unique property that he doesn't occupy, and he became self-employed 6 months ago, so we don't have any income that we can show for him. So it's a debt service coverage ratio where we use the rents from the property in lieu of qualifying, and that's a great rate. We shopped. Most lenders were in the high fours for that. Now, if you have an 800 credit score and you're putting 40% down and you're buying a single family for your primary residence, 4.375 is an awful rate. So those are all of the factors that we have to go in at. What's the purpose? What type of property? What's the purpose of the loan? What's the occupancy? What's the credit score? How are we documenting income? What type of loan program are we on? But yes, 4.375 is a high interest rate, but it can be appropriate in certain circumstances.
No, understood. Let's see here. So let's see. I saw a comment a minute ago I want to click on. So Hamid, why are you happy that the housing market's going insane? Even if that's the case, you should say otherwise. You influence people. So, I'm not happy that the housing market's going insane. Let's be clear. I'm just realistic that it's going insane and pointing out the fact, right? I mean, the titles, the thumbnails, think what you want about that, right? I mean, it is what it is. In order to get people to click on it. I never try to make clickbait. I always try to address, the title and or the thumbnail in a video. And essentially, the market is going insane. I'm not happy about it. I wish the market would calm down, quite frankly. Less appreciation, less craziness, being able to get buyers into properties, having more options would be a much better scenario. But that's not what's happening at the moment. So, we continue to do what we want. And why would I say otherwise if that's the case? I mean, it's, again, if I'm influencing people, I'm trying to help them make the right decisions based on that information, right? It's a fact-based approach, pragmatic approach, right? We're not here. This isn't an aesthetic conversation. This is listen, we're going to give you the information. You do what you want to with it. We're not here for your emotional needs, so to speak.
Facts over feelings, logic over emotion. I don't control what happens with the real estate market. I control how I interact with the real estate market and how I advise my clients and react with them. So it'd be silly for me to say, hey, I'm going to talk down the housing market, or I'm going to tell people, hey, it's not going to do what it's going to do because you think it's bad. And there's actually a follow-up comment here. Increasing gap between wages and housing prices not good for most people in the long run, not good for the economy. So here, I'm going to get about as political as you're going to ever hear me on YouTube. If you want to see me in person with some 805s, we can get political. But here in this context, we've said this multiple times on the show. We have one party in Washington who believes in giving away free money. We have people who think free money is a good thing. So if you vote for free shit, realize what that does over the long haul. Over the long haul, it adds to the debt. The debt makes it necessary for the government to manipulate interest rates lower. Lower interest rates inflate asset prices. The people who want and need the free stuff are hurt because they don't own assets. So the inflation of the assets is an obvious outcome of the low interest rates that are necessitated by borrowing a bunch of money to give money away. We have a party in Washington, D.C. right now that's trying to pass what they call a $1 trillion Build Back Better bill. But they've manipulated the numbers by saying all of these entitlements that they're going to act expire in 1 year. So the Congressional Budget Office has to go through and say, okay, as we analyze it, it's not a $2 trillion, it's about a $3 or $4 trillion. But if you look at it, we've never had an entitlement enacted and then later taken away. If it's not taken away over 10 years, it's a $6 trillion bill. So cool, give the stuff away. Emotionally, you feel like it's necessary, people deserve it, people need it, but realize what it does. It's going to continue doing the same things that we see: drive interest rates lower, drive asset prices higher, and the people that are getting the free stuff, the people that truly actually need the free stuff, are going to be hurt more by that. You can't manipulate a market economy based off of emotions. It has to go off of reality. So again, I can sit here and rail about this on YouTube as much as I want to, or I can act in the real world the way I think I should, because those are things I can't control, but they're there and happen. So I should acquire as much real estate as I can and hold it, because it's going to go higher, because our government is not going to change.
The mic, if I could grab the mic and drop it, I would, but then we wouldn't be able to finish the show. It would get ugly. So here we are. That's Josh's take on the market, if you guys are wondering. In the meantime, Keith has become a member of the channel, so thank you, Keith, for doing that. We'll throw that information up there. Keith, you are a member. You became a YouTube member. Hey, great. Appreciate it. Let's see what else we have. We're really reaching the end here. I'm just trying to find, I realize there's a lot of questions coming in. 2 hours is kind of our limit here. Wife and kids at home, all that good stuff. Don't want to make them wait anymore. She's going to show you
the new listings she's found that you can buy for her.
Yes, exactly. We're going to address one quick question here, Grace, and maybe one other. Would it affect our loan in a negative way if my husband pays off his $22,000 student loan? Would it negatively affect our credit score? I know our DTI would improve, though. So I guess my question before you answer that is, do you need to qualify for more, right? Like at this point, what's the point of paying it off? Because it could negatively affect you. And I believe you're in a position at the moment where you're in escrow on a property. And so you might want to wait until that closes to do any changing of things. But Josh, what are your takes on that?
There's way too much there to know. And I say this, Graciela and I have had conversations before. And what it really comes back to is you should be working with a professional that can answer these questions, that knows your entire file and can advise you properly. So, whether it's the builder's lender, or I know you've spoken with multiple lenders, whoever you're talking to, if they're not able to look at the file and give you solid factual reasons why you should be doing this or not doing this, you probably should be working with someone else. I'll say this for other folks. We just had, someone else pop up, say, hey, love the channel, help me buy. We get situations where people go out and they use whoever they're going to for the financing, but they're coming back and asking questions the whole way through the process. Make sure, Jeb and I are not the only people that know their stuff and can answer these questions. If you're not working with us, make sure you're working with someone who can get you the confidence you need to make these decisions. Paying off the school loan on that situation, it shouldn't negatively impact the score. The school loans are installment debt. Installment debt rarely improves the scores. So other than improving debt to income ratio, I don't know. But if we don't need to improve the debt to income ratio, why mess with it? Why take the 22,000 out of savings and do that? So those are the things that I would look at if we had your whole file to go through.
Got it. Kalar came back and said process if I'm getting a second home out of state as a second resident. So if that's the case, then you can't rent your primary out for rental income. Yeah, unless it is going to become a rental, and then you have rent that you're going to have to put on your mortgage application, unless you're living with a family member or what have you. So there's a lot of moving parts there. Unless there's something I'm missing, Josh, is there anything that?
No, if it's a second residence, if it's a secondary residence, then you're saying, this is my primary, this is my secondary. I'm going to get hit with both of those payments. We can't offset anything. The process. So what is the process if you're getting a second home? Process is no different. No different whatsoever, other than we have 2 housing payments to account for in the debt to income ratio. Everything else is exactly the same.
Good stuff. So we're pushing 2 hours here, my friends. I do appreciate you all. I'm going to do what I always do here, and I'm going to throw this a little thing across the bottom of the screen. If you want to get connected with a pro anywhere in the U.S., whether it's real estate or mortgage, click that link. We'll definitely connect you. Part of it's actually automated now, which is really cool. You put your information in. We have somebody call and set an appointment with the expert, which takes a little bit off of my plate and makes things a little bit easier on all sides. So do that. And then I would ask that you hit a thumb that points upwards like this with the finger up. Again, it helps the algorithms, which I know you guys hate hearing, but it does, and that's why people say it. So do that. And lastly, I will throw Josh and I's contact information on here so that if you want to contact Josh or myself, you can do that. I realize some questions weren't answered there at the end of the show. We'll be back next week live. Happy to address any questions we have at that time. If it's something that you really need and answered, you can email us. We're happy to go that direction as well. So, Josh, final comments. Anything you want to add here?
I'm going to leave
following tonight.
I'm going to leave tonight's final comments to Willing. I slandered him or her. No. Jennifer said she silences those who oppose you. He wants to see them in a back alley. So my apologies. He said
you wrestle alligator.
Yep. And you're a werewolf. So we stand corrected. I apologize for implying that you wanted to meet Jeb in a back alley.
But what does that even mean? I mean, a back alley, meet in a back alley. Hey, could mean a lot of things. Anyway, I'll leave it at that. Thank you guys for watching. As always, we'll be back next week. Hell, we might even show up on Christmas. Who knows? Santa Claus might be your gift for Christmas.
I'll have my Christmas pajamas on. I won't have the Santa suit.
There you go. Thank God. Anyway, people, thank you. Thanks for the support. Adios.